Okay, what's going on, everyone? This is going to be the second video for chapter 5. Last time we finished talking about annuities. That's great. So now we're going to pick it up with property dispositions, right? Kind of more in this passive income area. The idea with this is whenever you dispose of property, right, you sell it, you're only going to generally pay tax on what you made, right? In other words, we'll compare the amount realized with the adjusted basis, and the difference is either a gain or loss. Typically, the amount realized is what you sell it for. Typically, the adjusted basis is what you paid, right? So if we have a Charizard up here, right, if you sell it for $2 million and you paid 500,000, right, your gain in that case is going to be $1.5 million. In other words, you don't pay the tax on like literally the cash you got, only on what you made. The reason for this is that return of capital principle. The idea being is, hey, when you bought that Charizard up front, you used after-tax dollars for that, so we're not going to tax you on that again. There are some variations of this, right? So if you receive a gift, generally your basis is going to be a carryover basis. Whereas if you receive an inheritance, right, it's generally going to be the fair market value at the time of the decedent's death. We'll talk more about that in like the later points, so just kind of remember this and we'll come back to it. But for right now, we're talking about selling assets. It's typically what you make on it is what you pay tax. You also have potentially flow-through income, right? If you're a partner in a partnership or a shareholder in an S Corp, right, the partnership, right, let's just say they make 100 grand and there's 4 partners, 1, 2, 3, 4. The partnership's going to file that 1065, right? And they'll basically pay 0 of income tax on there. They'll file an informational return. And then each partner, right, will give you a K1, you'll get a K1. It will essentially show their share of that income, right? 25, 25, 25, that they will then report on their 1040. In other words, the income starts up here and it flows through to the owners, right? So this might be a 1065. Hey, we have $100,000 of income from the partnership. Here's your K1 showing your 1/4 share of $25,000. We would enter this tax document into the software, and the individual taxpayer, the partner, would have to claim the income. Alimony, right? We're getting into other types here. Well, it depends on when you got the divorce. So alimony is the transfer of cash under a written divorce decree when taxpayers do not live together, and that which ends upon the death of the recipient. Typically, alimony is meant to maintain like the lifestyle of the individual, right? If you were married to somebody who was really rich or something, or you were used to all these fancy trips and stuff like that, it would be like pulling the rug out from under you under the divorce. So to kind of maintain that lifestyle, we will pay alimony. Every court is different. Like maybe a general rule or something might be like every 2 or 3 years you're married, there might be 1 year of alimony. But when we talk about it, right, it depends on when you got divorced, right? So say we have a timeline here, right, 2018 and beforehand, right? If your divorce happened over there, we have one set of rules. If your divorce happened from 2019 and onward, we have another set of rules, right? Let's look at kind of like an old school divorce, 2018, right? You might have Brad Pitt and Angelina Jolie. Maybe they got divorced then. I don't know. Let's just say Brad Pitt has to pay alimony to Angelina Jolie, right? And let's just say it's $5,000 a month, right? Whenever Brad Pitt pays it, he's going to get a deduction, right? Kind of smiley face on there. And then Angelina Jolie, who receives it, right, she's going to have kind of a frowny because she has to claim it as income, right? So that's kind of like the old school alimony. Compare that with Miley Cyrus and Liam Hemsworth, right? Maybe they got divorced over here. I don't know. Let's just say she has to pay him $5,000 of alimony. In this case, and if you get divorced right now, whoever has to pay the alimony, they don't get any deduction on there, so kind of frowny face. And whoever gets the alimony, right, they get to exclude it, right? So that's how this kind of links up, right? We're talking about exclusions. If you receive alimony right now, that's excluded on there. Similar thing with child support payments. It also kind of follows that like current alimony rules, right? Whoever pays the child support doesn't have to, it doesn't get any kind of deduction for it. And whoever receives it doesn't have to claim it as income on there. Similar thing with property settlements, right? If you were married and there's all this marital property that you guys had together and then they kind of like dish that out after the divorce, if you receive that, that's not taxable income on there. It's excluded. One kind of iteration of this is your 401k and other kind of retirement accounts. If that grew or got bigger during the marriage and it was marital property, your ex-spouse can tap into that through this kind of quadro agreement post the divorce. So it's one kind of variation to be aware of, not that big of a deal. Let's look at some examples here, 514, 515. We'll kind of go over and check some of these out. So this is just saying, hey, here's an example of what you sell it. You only pay money on what you made. Here's an example of just some flow through income, how that might work on there. And then we're getting into the alimony, right? So in situation 1 right here, right, it was before or from 2019, so this is kind of old school on there. The person who pays it gets a deduction. The person who receives it claims it as income. Change that to like a current divorce, we flip it, right? Whoever pays it does not get a deduction. Whoever receives it does not claim income on there. So kind of this framework right here is if you get divorced right now, it applies for alimony, and then this same setup, no deduction, no income, always applies for child support, okay? Other types of income, right? Winnings, right? Winnings are going to be taxable, right? If you go on Who Wants to Be a Millionaire and you win $1 million, you're going to have to claim $1 million of income on there. So you might actually walk away with like $600,000 after you pay the tax. Same with gambling winnings, right? If you do the kind of all the DraftKings and all that stuff, right? You have to claim that as income, but then the kind of follow-up is, well, do I get anything for my losses, right? Well, it depends, and there's a rule set here, right? So the idea with this is you might get somebody who says, look, I won 10,000 during the year and I lost 7,000. Should I just like net these and report 3 as income, right? Well, that would be wrong, right? You don't do that. You have to report your winnings separately from your losses, right? So what you do here is you essentially report all 10 as income, and then your losses, right, you only get them as an itemized deduction, right? So there's like 7 down here. I don't know, let's just say the standard deduction is 16, right? Most of the time you're going to take the standard deduction. You can kiss those losses goodbye, right? So that's kind of the setup here. Yes, you can utilize the losses only if you itemize. And then if you do itemize, the best you can do, right? Let's just change it to 17, right? The best you can do is offset it to 0. It can offset it, it can't create an NOL on there. In the future, they're changing these rules a little bit, right? The best you can do is offset 90% of taxable income, but for purposes of this class and this exam, the best you can do is offset up to 100% of your gambling winnings on there. You can't create an NOL with regard to the winnings. Awards are generally going to be taxable. Treasure trove, right? If you find money on the street, stuff like that, it's going to be taxable. On their bargain purchases are not taxable, right? If you just get a good deal on something at a flea market and it's worth a lot more, not going to be taxable at that time, but if and when you go and sell it, right, then you'd have to figure out that disposition event. Social Security benefits, right? 0 to 85% taxable. In other words, the maximum they can get you, right? So say you have 10 grand of Social Security income, the most that will be taxable is 8,500. whether it's 0, whether it's 85%, it's a function of your other income. Don't get bogged down in that example. But the main thing you need to know is Social Security, yes, it's taxable. The most they can tax it is up to 85%. Other items, imputed income, right? So this is kind of indirect income. One of the most common one is below market rate loans. So I don't know, let's just say if you went to the bank right now and you borrowed $100,000, it might be a 7% interest rate. You pay $7,000 of interest on there. Your employer comes to you and says, look, don't borrow from the bank, right? You can just, we'll lend you the money and you can pay a 2% interest rate, $2,000. The difference there between what you would have paid on the open market and what you actually paid, that's like your employer gave you $5,000 of income. That's like a below market rate loan that you'd have to include on there. It's indirect or imputed income. Special rules, right? If you get discounts from your employer, right? One thing here is if it's an employee discount, then generally it's only taxable to the extent the discount exceeds 20%. So up to a 20% discount, you can potentially exclude. All right. COD income. All right. Cancellation of debt. So say you have a credit card, right? You owe 10 grand on this credit card. You're not going to pay it, right? The credit card company comes to you and says, look, if you pay us $3,000, we will forgive the remaining debt, right? Just pay us 3 and we'll call it a day. In that case, right, the amount you had forgiven is considered income, right? That's taxable income on there. You will get a 1099 on there for COD income. It's going to impact federal student loans in the sense that some of these repayment plans, right, they do forgive them after 20 or 30 years if you have certain federal student loans. When those are wiped, depending on what the tax law is, right, it could potentially be a giant cancellation of debt income. We also have illegal income, right? Remember, you got to report your illegal income and your stolen income. Like, who does this, right? But you still have to. So one of the ways they got Al Capone was, right, they couldn't prove all of these other sort of ways, like you're doing this, you're doing that. But, oh, hey, you sold all these drugs, or, you know, you had all this income that you didn't claim. That's tax fraud. We're going to put you in jail for that. So a CPA was the only one who was able to get Al Capone. All right. Muni bond interest income. We've talked about this in kind of previous chapters. The idea with this is you have a municipal bond, like, hey, maybe this bridge goes down, so now the city of Pittsburgh is going to issue bonds. You give them 10 grand, they give you $100, they give you $100, they give you $100, and then you get your 10 grand back. Because that bond was from a state and local government, the $100 you got the multiple times, that is excluded from income for federal income tax purposes. Things get a little bit wonky at the state level in the sense that most states only give the preference for their own municipal bonds, right? So I don't know, let's just say we have scenario 1 and scenario 2, right? So scenario 1 says this, we have an Ohio, or I'm sorry, we have a, let's just say a PA muni bond of $5,000 of interest. If we did the Fed return, right, they'll not have any income. If we do the PA return, they'll not have any income, right? Because it's like its own state muni bond. Compare that with scenario 2, right, where we have a $5,000 Ohio bond, right? On the Fed return, right, there would be $0 of income. On the PA return, right, because it's another state, it's an out-of-state muni bond, we would include the income there. So it's like something you do have to do in practice when you look at these kind of state items and considerations. Another thing is the gain on the sale of personal residence. So let me kind of just like map this out over here. Right, so we talked a little bit about disposition events. When you sell it, you only pay the tax on what you make. Right, so say you have a house and you buy it for $300,000. Right, you live in it for like 10 years or something, and then you sell it for $700,000. So we know from before, right, it's going to be 700 is your amount realized, and 300 is your adjusted basis. what you paid. So you're going to have a $400,000 gain on that, right? So you have to pay tax on $400,000. This is where this exclusion comes in, and it says this, right? We measure from the date of sale. We go back 5 years, right? Wherever 5 years was. When we say during that 5-year window, did you live and use this property as your primary residence? In other words, did you live there, right? You weren't renting it out and stuff like that for at least 2 of the last 5 years. If yes, then this gain you can exclude if you're single up to $250,000 of that amount, meaning the remaining leftover $150 is taxable. So it's not an unlimited exclusion, right? Like a lot of times people say like, oh, you sell your house, as long as you live in it 2 years, you won't have to pay any tax on that. Well, that's not true, right? There is a kind of a cap on this. So like if you were in California and you sold your house for $2 million and you had this giant gain, that might be a problem, right? So like say you paid $300, now we sold it for $2 million, right? Our minus 300, there's a 1.7, yeah, only 250 of that you exclude. In these situations, right, where you have a highly appreciated asset, right, this is where those other kind of BASE rules comes into play. And it essentially says this, right? Don't sell it during your life, right? Wait until you pass away, right? So like say you pass away right here, give it to your kid, right? Because what will happen is if your kid then goes sells it, right? They'll sell it, it's worth $2 million, right? That's their amount realized. They will take a stepped up basis. In other words, what your basis was on the date of sale or on the date of death when you passed away becomes their basis, such that right now their basis is $2 million, they have $0 of tax. So it's kind of like an estate planning strategy, this stepped up basis rule. For a gift, it's a carryover basis. Right? In other words, whatever the person giving the gift, whatever their basis was in the item becomes your basis in the item. How about fringe benefits, right? These are basically non-monetary compensation. As a general rule, they're going to be taxable, right? So like, for example, if your employer pays for your moving expenses, hey, here's $5,000 to move from Pittsburgh to New York City, you're going to have to include that as income. That's the general rule. There are exceptions, right? Qualified fringe benefits, right? They essentially qualify to be excluded from income. So you can read through here. There's definitely different threshold amounts for all of these, but like maybe a simple one is just like medical insurance premiums. When you work, right, like you'll have health insurance and your employer may pay the monthly premium or a portion of that monthly premium. That's like you got something, right? Do I have to include that in income? No, that is a qualified fringe benefit. I can exclude it, right? So there's all these things like, oh, hey, you want to get your MBA, your employer can give you something like up to $5,000 or $6,000 a year that you can exclude from income towards that MBA. Like meals, right? If they give you meals there, you get to exclude it if certain conditions are met. De minimis fringe, like, I don't know, you take a pencil or something from work, right? Is that going to be taxable? No, that doesn't even rise to the level of being taxable. All right, just to quickly talk about this, accountable plan versus non-accountable plan. There may be situations, right, where you incur as an employee at your work out-of-pocket expenses that the employer reimburses. Like, hey, I'm going to a conference. Your employer says, just pay it, give us the receipt, and then we'll reimburse you. Depending on whether the employer has an accountable plan or non-accountable plan, that will be taxable to you. If they have an accountable plan where essentially you just give them the receipt, right? Oh, here's my receipt for the conference, then as a general rule, that's not going to be taxable to you. Whereas a non-accountable plan tends to be more like, here's some money we give you each month for expenses. In that case, when there's that kind of routine recurring money, it's typically going to be taxable. Other types of exclusions, right? Scholarships, to the extent they're used for tuition fees, books, supplies, and other equipment, are excluded, right? So say you get a $10,000 scholarship and you're like, all right, I'm going to pay my tuition with it. Well, then that will be excluded from income. Compare that with I get a 10 grand scholarship and I'm going to use that to pay my room and board, right? In that case, it would be taxable income. Or compare that with I get a 10 grand scholarship and I'm just going to pocket the money, right? That would be taxable income. Likewise, if you have to provide services for a scholarship or like you work for the university, it's going to essentially just be like earned income, right? It's going to be taxable to you. So if you're like a GA or TA and like they pay you a wage for that, that will be taxable income. Talking a little bit about education, right? Just to highlight 529 plans. So these would be like if you're saving for college for your kid, when you contribute the money into the 529 plan, there's generally no like federal benefit you get. At the state level, they might give you like a deduction or credit. But say that we put like 60 grand into the 529 for our kid, it grows to 100,000. If we then use this money from the 529, we push it out to pay for their college. The difference there, the 40, we can exclude on there. So that's kind of why it's in the exclusions. 529 plans, if you use them for the right education expenses, can be excluded on there, the kind of the growth. Similar with Series E savings bonds. Hard to qualify for this. There's a lot of rules with it, but like theoretically, if you get interest from a Series E savings bond, the federal government, and you use that interest income to pay for college or education expenses, then it's not going to be taxable. Okay? Gifts and inheritances, right? We kind of keep talking about these, but a gift happens during lifetime, right? So grandpa gives you his car while he's alive, whereas an inheritance happens at death, right? Grandpa or grandma passed away and they give you the car. For federal income tax purposes, right, the 1040, a gift and inheritance is not taxable income. Okay, so like you get this stuff, you're not going to have to claim it on your federal income tax return. There are other taxes in play, right? There is a federal estate and gift tax, but that only kicks in, right, once you give something like $15 million of gifts. And grandpa, the one who like passed away, he would be the one who pays it. So like if grandpa had like 300,000 in his account, it's like doesn't even come into play. It only comes into play once you start giving more than $15 million worth of stuff. So most people, like 99% of people, don't even get it. On the flip side, right, there is a state level inheritance tax, at least in PA. Not a lot of states have these. And it's not the decedent who pays it, it's the beneficiary, right, the one who gets it. So in this case, depending on your relationship to grandpa, if you inherit stuff, right, yeah, you're not going to have to claim it on your federal income tax return, but you might have a PA inheritance tax that you, the recipient, have to pay on that. Life insurance proceeds, right? So a life insurance policy is something like this, right? Like I have kids, I'm going to buy a life insurance policy. In the event I pass away, it will pay out to my kids, right? So like maybe I buy a policy for 100 grand. There I am, that's great. I pass away and then it pays out to my kid, I don't know, 500,000, right? If as a general rule, if you are a recipient, a beneficiary from a life insurance policy and you are the one getting that money in a lump sum, you are going to exclude it. Life insurance proceeds are excluded from income. If you take the money in installments, right, then there is potential, you can read through that, for like earnings and growth that you'd have to pay tax on. But don't make it any more complicated than this, right? You receive life insurance proceeds, maybe mom and dad or somebody passed away, you get this money. As a general rule, it's not taxable. Things get more wonky and you can read through this, right? So like if you have a policy, right, you can kind of front load or take the benefits ahead of time, right, where you can exclude some of the income. You could potentially sell or cancel your life insurance policy where there's potential tax effects on that. I wouldn't be worried about that for the exam, but you can read through it if you want to. Another exclusion is the foreign earned income exclusion, right? So we got Pope Leo here. He is a U.S., Chicago person, so he's a U.S. citizen who is working overseas, right? Let's say he makes 100 grand over there. The foreign earned income exclusion basically says this: if you're working outside the U.S. and you really live there, right? Because there's like a requirement that you got to live there for more or less the whole year, then you can exclude up to a threshold amount of earned income, something like $130,000. So in this case, hey, you work over there, you can just exclude the income. They also have like a foreign housing exclusion and stuff like that. But this one, you really have to live overseas. If you just go over there for like 5 weeks or something and you make some money, you wouldn't qualify for the foreign earned income exclusion. You'd probably take the foreign tax credit. Workers' compensation, right? So you slip and fall, you're injured at work, right? You kind of get paid out from a workers' comp plan. That is not taxable. However, compare that with unemployment compensation, namely a wage substitute, which is taxable, right? So obviously if it's a wage substitute, it's just substituting working at your job, then it would be just like you're getting paid, it's taxable. But if you're hurt, it's your work, you get workers' comp, not taxable. Unemployment is taxable. Government assistance programs, right? Like you receive welfare, SNAP, things like that. They're not going to tax that as a general rule. That's going to be excluded on there. How about lawsuit proceeds, right? You sue somebody, you win money, or you sue somebody and you settle. Like 99% of cases settle, very few cases go to court. Well, it depends, right? If the proceeds from that, like what kind of a suit is. If it's a physical injury, then it's excluded from income. So by way of example, I go into Walmart, I slip and fall, I break my arm. I sue Walmart for 100 grand. It's a physical injury, a broken arm, so I can exclude it from income. Compare that with pure emotional distress, which is included in income. This might be something like, oh, I'm suing you because you were making fun of me online or something. You hurt my feelings, right? I have emotional distress. If you get money from that, that's going to be taxable. And then punitive damages, which are meant to punish, are always going to be taxable. So it could be something like you slip and fall in Walmart, you get 100 grand for the broken bone, not taxable. They also tack onto that 900,000 to teach Walmart a lesson on there. Well, the 900,000, the punitive damages would be taxable. Healthcare reimbursements. If you get reimbursed from a health or accident insurance policy for medical expenses, that will be excluded from income, right? You're in the hospital and your health insurance actually covers something. Most of the time they're like, oh, we don't cover that. But in the rare event they do cover something, that doesn't and is not going to trigger taxable income. Disability insurance, this one's a little bit wonky. You have to kind of analyze it. It depends, right? If you're just a private citizen, like say you have a job, that's great, and on the side you buy a disability insurance policy. And a disability insurance policy says this, like I'm going to buy this policy and if I become disabled, it'll pay me out to like help take care of myself. But if you pay it yourself, right, out of pocket, right, you're not getting any deduction, so it's kind of like frowny face there. Then when you get the proceeds, it's excluded from income, kind of smiley face. So you buy it yourself, you get paid out on it, you can exclude. If your employer pays it, right? So like I work at my job and one of the benefits they give is they're going to pay for a disability policy. How that is treated to me depends on if it'll be taxed. If it is taxable compensation, right? Frowny, right? Oh man, I got to pay tax on it just like up there, frowny. Then it's the same outcome over here, smiley. It's excluded. If, however, it's a non-taxable fringe benefit, that's how they treat it. Like, oh, we're not going to tax it on you, right? Smiley, oh, that's a good thing. I don't got to pay tax on that. Then it's going to be frowny on the back end, right? They're not going to give you that double dip of the two smiley, like, oh, you don't have to pay tax here, and then you don't have to pay tax there as well. How about residents with minimal rental use? So if you have a residence, the place you live, very complicated rules here, but generally you can rent it out for up to 14 nights of rent and exclude that income from your tax return. So say you live right next to the stadium, right? And the Steelers play 10 home games. Oh, I'll rent it out every Saturday night during the football season. It'll be really in demand, and I can exclude all of that income from my tax return. So if you ever want to buy a house or you're looking for maybe like a vacation home, right? This could be a strategy you use where you can exclude income on there. Finally, qualified opportunity zones. These are kind of something that came out of the TCJA. A qualified opportunity zone is an economically distressed area, like the US government says what these are. How it works is, like, say you're sitting on a capital gain, right? This $100,000 capital gain, right? Maybe you sold it for 9 and you paid 8, right? Oh no, I have this gain. What it says is if you take this gain and you invest it in a qualified opportunity fund, right, depending on how long you hold it when you purchase it, there's a lot of timing and restriction things here, but theoretically, if you did this, it is possible where you could defer or potentially exclude this gain on there if you invest it in a qualified opportunity zone. So these are kind of newer things post TCJA. A lot of kind of fine details with this, but it is a type of exclusion. Okay. So with that, we're at the half-hour mark. I'm going to stop it here. We'll finish chapter 5 at this point in time.